Welcome back to VC the Venture Capital TV, and it's from La Token. My name is Sunny Mohanty. I'm the Regional Director of La Token based here in Singapore, and I host VC. And I love being a part of VC because of the community we have built up over time. It's the VC Family Hour, as all of us say. And let's meet our family members. Yay, you go. Great. Okay, we have a full house today. I'm very excited. And we're talking about SPAC, okay? So let's have a quick round of intro of the family members who have joined us today. I'm going to start with Peter. Hi, Peter. Welcome back. How are you?
Oh, Sony, it's always been a pleasure to see you and the whole LA Token team. I'm really excited to be back on LA Token. As you know, I've had some personal family issues and I've been traveling extensively. So I am looking forward to today's chat on SPACs, which hopefully I could add a lot of value to your audience and the participants, and also to the future things. My name is Peter Plout. I'm the Executive Director of the Weimer Family Office. The Weimer Family Office is a multi-family office based in London and Denmark. We're a multi-billion-dollar family office, and we focus on various asset classes. Real estate is at our core, but we also look at metals and mining, alternative energy, space and exploration, satellite and telecommunications. Separately from Weimer, I'm also working on developing 3 SPACs, actually, one in the AI space with one of your guest speakers, Gary Fowler, and his partner, Derek. We're also looking at a SPAC in the hospitality space where we merge fintech and real assets, as well as the digital world. And then we have a third SPAC as well that will be announced shortly. So definitely have a lot of value to add in terms of what we're currently doing in the SPAC space, how family offices look at it, and also from a historical perspective. Many people think SPACs are the new sexy medium for tapping the capital markets, but they've been around as long as time, and I look at them as just a means to an end, as another way to access or tap global capital markets. Nothing more and nothing less, and we'll discuss that on today's call.
Absolutely. Thank you so much. Thank you so much, Peter. So that's a great intro, and I'm looking forward to hear all those SPAC deals that you've done. Okay, great. Next, I like to have Karthik. Hi, Karthik. How are you? Long time no see. Where did you go?
Oh, yeah, I wonder. Good afternoon. My name is Karthik. I'm from the Middle East, currently traveling on a holiday for next 5-6 days. I represent a couple of family offices which are into edutech, health tech, a lot of government to government tech, and a lot of government to government primary funding businesses, as well as I represent a venture fund based out of Saudi, which is more into banking and space tech. An angel investor myself and a chief operating officer for a large retail business. I haven't been into the spec space for a while now, considering the kind of investments we do. But there's been certain discussions with a couple of partners, including Gary Fowler, to be a part of his SPAC. Let's see how it shapes up in the future. Thank you so much.
Wow, everybody over here is talking to Gary Fowler, and he's not here today on the panel. Thank you so much, Karthik, and welcome back, and happy holidays, and happy Eid.
Yes, thank you. This is, by the way, the 134th episode that I'm doing with you, Sunny. I still keep a track. My Google keeps a track. This is my 134th episode with you. So pleasure.
Right. Welcome. Okay, next I'm going to go to our guest who also disappeared for a while. Sorry, Kingsley. Welcome back. Where were you? Where did you go?
I was in Nigeria actually for about 5 weeks. A lot of opportunities there right now. Growing region that one has to look into investing in, and I was happy to be there in person to look at different projects and see how we can move them forward. All that being said, it's good to be back at La Token. Sonny, you still have that energy and contagious laugh or smile. Let me put it that way.
Thank you.
Anyway, I better speak Japanese. So I'm really happy to be back here. My name is Kingsley Kobayashi. I am the founder of Kobayashi Group. Kobayashi Group has a lot of companies under it. Like we have HBK, which is a naturalist medicine, making company. We have entertainment. We have healthcare. We have commercial real estate. We have Hurricane International, which is into different kind of trading. My company invests in different areas, especially blockchain. We also invest in traditional finance projects, as long as they are profit oriented and the projects are good. Like I said, there's no bad projects. If your project is bad and you bring it for us, we'll add other projects to it, marry with other projects, and give you ideas to make it better. So I'm happy to be back there. Sonny, nice to see you again. Nice to be with everyone, and I look forward to learning and sharing ideas with everyone.
Great, and thank you, Kingsley, for joining us back. Sorry, I'm just seeing Koyashi group, so yeah, it's okay. Thanks for joining us back after your Africa tour, but yes, great to have you back. Last but not least, where do I go? Okay, I have Dr. Shrikant, who's just joined us. Hi, Dr. Shrikant, how are you today?
Can you hear me?
Yes.
Nice to, very well. Nice to see you, Karthik. Karthik, enjoy your holidays. It should not be an impediment for your holidays. Kingsley, nice to see you. Peter, pleasure to meet you. I think I'm meeting you for the first time. So that being said, I act as a general counsel for certain family offices. They happen to be in the Forbes 500 list. So let me be optimistic that they stay in the Forbes 500 and they do not drop out. And it so happens that we engage, when we structure a deal, we engage in a lot of structuring involving SPAC. So I'm here to give you a perspective from a legal angle in terms of what investments are happening or what investments are being shot down. So I'm going to be the pessimist in the group. I'm sorry, I'm a recurring guest, unlike the other guests who are quite. I would say.
Are you okay, Dr. Shrikant?
No, talking about SPAC just gives me emotional feelings, possibly. Something like that.
Feel emotional, nothing else. If SPAC makes you feel emotional, beautiful.
I don't know what was that. But anyways, I hope you can see us clearly, because it's very important for you to be see us so that we can discuss. So
this is me. So Dr. Shrikant Patsapi. So counsel, that's it. Nothing more, nothing less.
Please, while you start get your glasses fixed, or maybe whatever, I'm going to probably start with a little bit of background, okay, about this topic, because this topic, SPACs, I'm not involved in SPAC of any sort. That I'm here to hear from you guys and learn from you guys. Hence, so I'd be very, very attentive today to whatever you speak. But a little bit of background that I have gathered from the net. So as the market continues to see high levels of liquidity, depressed valuations, and a strong appetite for growth and disruptive companies, SPACs, which is a special purpose acquisition companies, have had a recent resurgence. While the economy recovery may be slow, it has opened the IPO market for SPACs, which are shell companies, as we know, created for the sole purpose of taking a private company public, and have been playing a significant role in M&A market as the capital has flowed in at a staggering rate. Okay, so this is my opening remarks about a little bit of background about what a SPAC investment looks like. But I like to hear more from our speakers today. So who are the different players in the SPAC ecosystem? I'm going to start with Karthik. Karthik, so basically, what is very confusing for me when I actually go and look into SPAC on website, on internet, I get a little confused with who are the ecosystem players, who are actually taking part, who is the investor, who is the SPAC company, who is the startup, and who is acquiring who, and who is going to go IPO. If you could share those fundamentals.
I would look at it this way. SPAC's not a new phenomenon. SPAC's always been there in different shapes, sizes, and structures. It's about putting the horse before the cart or the cart before the horse. If I am a small startup and if I want to go public, I'm going to draw valuations basis my fundamentals, basis my business, basis my pedigree, basis the performance. So valuations are going to differ. Dollars on the table would differ. Investment thesis and investment opportunities would differ. However, When we go the SPAC route, which is where a few people who've got an idea about what's the kind of money they have, and they try and create a consortium, and then they go public and get crowdfunding, a different way of crowdfunding, putting dollars on the table, and then they go out hunting for a right deal in terms of what corporations or what companies, private companies, need to go public. The idea is the valuation or the dollar available on the table versus the fundamentals of the business are kept separate, and there is a very strong opportunity to do fair due diligence in terms of investor interest, in terms of finding out whether the investor's money is getting jeopardized or the private company is getting the right listing. Obviously, there's going to be a little bit of shave off in the listing when the company is bought over. But the marriage of fundamentals, marriage of merit, and marriage of pedigree of the dollar and the organization is done in a very fair manner with a very strong de-risking fundamentals around it, which means the fail-safe limits are significantly lower. Speculative interests are curtailed to a very large levels, and hence we generally do not see the kind of upsurges that we see on IPOs, where it either gets oversubscribed or it gets into valuations which are fictitious and book wise. So there is a very strong merit in terms of creating a SPAC or creating a dollar pool through crowdfunding or whatever route you want to call, and then start looking for appropriate opportunities or targets in the market. The hunting is done in a right manner, properly, through due diligence and through fundamentals, and not through speculative interest, which is where I see SPACs being far more dominant and structured instruments of investment than a typical IPO route.
Absolutely. Thank you so much for that intro insights into what the SPACs, because today's topic is which companies are great targets for merger with SPAC, and you rightly highlighted on that as well. Thank you, Karthik. Next, I'm going to have Peter, who's obviously working on 3 SPACs, I guess, Peter, right now?
Yes, that's correct. So let me just follow up on the comments made previously. Yes, SPACs have been around for a long, long time. And as I opened my opening remarks, it's a means to an end. It's a way to bring a company to the public markets, to tap into public markets for access to capital in a somewhat more efficient way and somewhat a faster way. However, you need to understand, first of all, I don't think that companies looking to raise venture capital money is necessarily an appropriate means for a SPAC investment. It needs to, unless that company has a technology, a platform that makes sense for that acquisition. Remember, at the end of the day, if a company is going to remain private, it wants to remain private for its own reasons. It means it can operate more efficiently as a private company. So the first question that management must ask of an existing company to be acquired is it better served in the public sector domain in terms of as a public company with all the requirements in terms of regulatory and reporting requirements to a retail and institutional investor base, or is it better off being outside of that regulatory and scrutiny of the public markets and remain in the private domain? Where can it operate more efficiently? That's question number one, and the management needs to ask that. The second question is the acquiring company, as in the SPAC that's looking to acquire that company, can they operate that company more efficiently after its acquisition than the current state of the company? Yes or no? Meaning, can management of the SPAC, does it have access to better management teams and operating teams and portfolios of companies that can make that acquisition candidate more efficient, bring to it economies of scale, and basically improve the valuation of that company as a publicly traded company versus remaining in the private domain? If the answer to both of those questions are no, then that company is not an appropriate SPAC acquisition candidate and should remain in the private domain. The third thing I would mention is any industry, any company can be part of a SPAC. That's not the question. The question is management. What is existing management of that company, and does the management of the SPAC that's looking to acquire that company bring into foray complementary skill sets that could again increase the valuation of the company than if it was just remain standalone? That's the overriding thesis. Because at the end of the day, an investor investing, whether it's in a SPAC format or an IPO format, etc., is in the longer term, is value created? If it's not, and if our value is destructive, okay, then again, it's not an appropriate acquisition candidate. And that's regardless of whether it's via the SPAC means to tap capital markets or an IPO or just an outright acquisition in the private domain. So that's what's most important here. So when the question is what companies are attractive for SPAC acquisition, I think it goes back to the fundamentals of, is the company better off remaining private, or is it better off in the broader sense of having a broader access to capital markets? From a retail investor point of view, a SPAC is an interesting forum because you put in cash and you get that cash back if an appropriate candidate has not been identified in 12 to 18 months, because that cash is invested in treasury security. So your underlying risk is mitigated by the fact that if an acquisition can't be found, okay, then the money is returned to the investor. So I'll leave my comments on that and turn it over to the rest of the team.
I have some follow-up questions, but I'm going to take that later. But thank you so much, Peter. Such nicely explained as opening remarks, and really, you just opened up my brain. Thank you so much. Next, I'll have Dr. Shrikant to add on your opening remarks, please.
So let us ignore the elephant in the room when you deal with SPACs, right? I mean, the elephant in the room is a legal question. I think for a SPAC to thrive, you need to have a regulatory mechanism which is not very ideal for a particular startup to basically thrive and go public. Now, coming from India, I can give you a perspective that we have got 10 companies which have listed in the past 10 days. And the news as of today is that a small or a medium company, according to the definition in India, which is doing about $70 million in the overall listing. I mean, which is raising $70 million. Remember, the market cap itself is $70 million. It actually opened up to an IPO, and it has been oversubscribed 180 times, 180 times. So which means that the regulatory mechanism is actually, I wouldn't infer that the regulatory mechanism is actually helping. But what I'm trying to say over here is the India's regulatory regime is actually changing. Now, for a SPAC investor to thrive, it should be, all the negatives should be there. The regulatory regime should be against you. You would not be in a position to list it if not for a regulatory position. It could be any of these regulated countries like China or possibly Singapore, which will give you better premiums, so on and so forth. That is number one. Number two is, insofar as SPAC is concerned, we are talking about, I hate the whole terminology of shell company, because a shell company typically means a tax evasion, and it doesn't sit well with me as a counsel, as a qualified accountant, to actually say shell company, right? So it means a company where you're making an investment for which you are going, using it as a conduit for going public. So in terms of SPAC investments, I think the right markets are the markets possibly where you get a bigger premium. And I couldn't think of any other market where you could get a bigger premium than India at this particular moment as we talk, because the optimism is so high that every company seems to be oversubscribed over here. A loss-making company seems to be oversubscribed in India. So you couldn't imagine that in a Singapore market, or you couldn't imagine that in London Stock Exchange, or you couldn't imagine that in the NYSE. So the point I'm trying to make over here is the regulatory compliance, albeit and harsher. I think India is a good market for. I would rather instead of saying which companies, I would rather put it as which geographies are good geographies to actually look for SPACs. And I would say India is a good geography to look for SPACs.
Wow. Well, very good to know that India is one of the geographies for doing SPAC. Because when I was reading, I was going through articles. It said USA, and a matured markets. But good to know, Dr. Shrikant. Thank you so much. Next, I have Kingsley from Kobayashi Group.
Hello, everyone again. I really agree with Mr. Peter there. His analogy, the way he explained it, is all about value. What the valuation of the company, what value can the SPAC add to the other company? Because if you just want to become the president, for example, and you have no idea of becoming the president, you already have a problem. If the question is, are you actually better managing your own company yourself or giving it to others to manage for you? And those you are giving it to, do they have the experience to manage that company? Do they have the resources? Do they have the expertise? For example, we are talking about, let's say, technology, for example, AI technology. You're not going to give an AI technology company to a real estate company because it's a SPAC company. No, you need people that have that experience. So the experience of the SPAC is very important. The valuation also, it has to be 2-3 times more than what it is right now. So a lot of things need to be put into consideration. So it's not just about, oh, I want to do an IPO, I want to put my company out there to be public when you don't have what it takes for it to be public. First of all, you have to have what it takes. So the due diligence has to be made by both parties and say, okay, what can you offer me? This is what I'm bringing to the table. So you look at what values you are bringing together, and then if that values align, then you can actually work together. So the company itself is important. The technology backing it up is important. Like now, environment is there, but people think that SPAC is a new concept. Just like they think NFT is a new concept. But these things have been around for a very long time, but it's been dormant. So in 2020, 2021, because of the COVID-19 pandemic, a lot of people are now trying to do shortcut. I call it the shortcut syndrome. You don't want to go through the process, but you just want to start from the head and then work your way back down. Yes, it helps you with liquidity. It helps you with cash flow to run the company for some time. But if you don't have those basic things that will make the company last long, you are going to fail anyway. So all these things have to be put into consideration by both parties, whether you are the one acquiring the company or you are the one looking to be acquired. You have to put your values, you have to put your do's and don'ts, put your the advantages and disadvantages on the table for both parties to look at and say, okay, yes, we can work together. If that is agreed upon, yes, it is a very good way of getting yourself up in the public at an early stage instead of going through the process of IPO and things like that. But don't forget that once you get there, you're going to be regulated by SEC, by the public, by things like that. Most companies don't want that attention. Most companies are better just the way they are, but they don't realize it. They just want that name. Oh, I'm a public traded company, which is not how it should be. So we should look at the values that are being brought together by both sides and make it better. That is just my thinking about SPACs. Whether it's technology, whether it's environment, whether it's entertainment, call it hospitality, which I'm into. We're always looking for added value, and that will make it better.
Thank you so much, Kingsley. I really like the way you said it's a shortcut to go public. So SPACs are being backed by investment banks, hedge funds, PE firms, and venture capital firms. For sellers, SPACs expand the investor pool, as we already said, and provide a way to access capital that otherwise might not have been available for a small private company, and maybe more desirable than an outright sale to another corporate or a PE buyer. So 2020, as we all over here discussed, right, was thought to be the year of special purpose acquisition companies, SPACs. Yet, SPAC IPO volume in Q1 of 2021 quickly went down, eclipsed the full year 2020 tally. In particular, M&A in the tech sector continues to draw a large amount of capital from SPAC. But eclipsed, I meant. but will this investor activity continue growth? What do you forecast? Is it going to continue growth or is it going to fizzle out? So let's start with Peter.
Okay, a couple things, Sony. Number one, and I appreciate learning about the broadening and deepening of the Indian marketplace for SPACs. I think that's a very positive development for an emerging economy. However, from a retail investor point of view, safety, um, regulatory environment, obviously the U.S. is the broadest and deepest
Yeah.
capital market, and obviously the most attractive market for an investor in SPACs, simply because of the regulatory framework that's there and the historical framework for dealing with SPACs. In terms of the growth in the SPAC market, in the first quarter and into the second quarter of this year, we saw weakness in some of the share prices of
Yeah.
SPAC. And, that's probably a welcoming scenario. You can't have everybody and their mother deciding to issue a SPAC. So LeBron James issues a SPAC. I mean, what value does he possibly add um, as a management personality to acquiring a company? Obviously, he can surround himself with very smart people, but the reality of the situation is anybody could form a SPAC, but unless they have the management team that's capable of executing operationally to
Yeah.
create value for a company, that won't work. So I think we saw too many SPACs coming under two different many names, okay, flooding the
Yeah.
market, leading to
Yeah.
weakness in the market. But the market is the final arbiter. The market will distinguish between those SPAC management teams that have a historical track record in operating and creating value for their shareholders. And thus, we're starting to see that those fundamentals resurface. And I think going forward, we will see this year and into next a accelerated growth in SPACs coming back to market
Right.
as the equity market remains attractive for them. However, the market's going to clearly differentiate between the winners and losers. And I pound the table: management, management, management. If the ownership of that SPAC has a
Mhm.
deep and broad bench of talented management related to the industry or industries that are going to be acquired, or the company that's going to be acquired, okay, that SPAC will perform well. In the outset, poor management or a new management team that was created just to take advantage of these high valuations will fail. And that is the same whether it's an IPO or any other medium for tapping capital markets. So, to answer your question, we will see an acceleration in growth after the weakness, and there'll be a bifurcation in the markets between those that have the management teams with the operating prowess and those that don't.
Wow, that's good to know in terms of the number of the future of SPAC as a whole. Thank you so much, Peter. I'm going to next go for Kartik. So, Kartik, you are on mute.
I agree a
So,
lot with Peter. I bring a perspective on the family office's view on SPAC. See, if you remember one of the deals that we were discussing last month around Sunny, where for a family office like ours, was extremely conservative and funds only scale and doesn't necessarily fund startups and doesn't necessarily get into your pre-series A, which is the bamboo shoot route of business. For us, it's a very, very safe and conservative route to going into the business with a right route of direct investment. We generally do not prefer indirect investments into businesses. And this gives us a very strong understanding of the kind of people who are going to run the SPAC and going to add value to the business. If 1 + 1 is supposed to make 2, then we are not in the business. The moment 1 + 1 starts making 3 and more, which is where the non-intangible value in terms of management, in terms of scale, in terms of market expectations, in terms of competencies and vertical integration into the business, or affiliations, non-monetary affiliations come into play, is where family offices like ours start feeling comfortable that yes, this is a place where we would want to go, and hence dollar pooling would become that much more easier. Cherry picking the organizations which we want to partner, cherry picking the companies that we want to buy out, or be invite into the SPAC, depends on the sector and the kind of SPAC that you get into. But for us, it seems to be a far more safer route to market than the venture route to the business or the private equity route to business. So from our
so
perspective, we see ourselves being very, very bullish in participating in some of these SPACs.
wow, Kartik, that's like a eye
See,
opener.
it de-risks us. It de-risks. We've always been looking at it from a startup or from a private limited company's what is the value add that it brings to a table. But look at somebody like us who's always been dealing on government to government basis on large businesses or have been funding businesses which are typically already making money and need funds for scale. For us to get into a venture fund ecosystem is very, very challenging when we are shooting in the dark. Here, we exactly know that the man who's driving the machine is not only competent enough, but has a very strong track record. And the decision that he's going to make into acquiring a business also comes in with a strong pedigree that could have gone public on its own. So it de risks us on both sides of the business and allows us to fund that much more for scale. So the transactions post the buyout also becomes that much more easier at any point in time.
So are you talking about you betting on the management team here or on the target?
So it's both. It's betting on the management and betting on the target because both of them are vetted and both of them are thoroughly scrutinized before the decisions are made, compared to a blind that we would go either on a venture fund or on an IPO. So from a family office point of view, participating in decisions and SPACs becomes that much more lucrative.
Very good. Interesting. Very interesting. Thank you so much, Karthik. Dr. Shrikant. So, Dr. Shrikant, you also work widely with family offices. So,
yes,
what's their viewpoint?
No,
Is that aligned with?
see, I completely agree with Karthik over here as far as the returns are concerned, and so far as let me give my position in terms of what Peter said. While the US remains with a dominant position in terms of the safety net that it offers, I would still urge him to consider the untapped markets, where the risk premiums or the valuation may be quite low for a particular investor to invest, where the returns could be substantially higher than the typical LIBOR plus. So what I'm trying to say over here is, from a family office perspective, what we do is, to me, at least a SPAC investment is just a structural mechanism that we use for entering a particular finalization of a particular deal, right? To me, SPAC is not an instrument on an asset class itself. I may be quite wrong. I mean, I may be differing from the different family offices that have a differing practice. Even for a conservative family office, we are not a conservative family office. We are a mid-conservative family office, somewhere alt-right family office. We do not see that as an impediment to our investment opportunities that are available. So if we were to take a position in a particular startup, and we were to invest in that particular startup and expect a particular IRR of, say, a double-digit IRR, I wouldn't be essentially considering SPAC as the first element of discussion with that particular startup. So to me, SPAC is more of a secondary conversation that I would have rather than primary conversation. So I would rather differ from the panel in terms of the views that I have experienced insofar as the family offices that have represented.
So one more question. So basically, you mentioned, like Peter mentioned, that US have been always been the dominant jurisdiction when it comes to more successful SPAC deals, right? What's the reason like India picked up? Is it because of the pandemic? Sorry, I missed that point maybe.
No, there were geopolitical reasons that led to US not declining, but there was a bit of an uncertainty per se. And look at the Indian capital markets. I mean, we have zoomed up, literally doubled our index. And why would an investor not ride on the bullish sentiments that we have in the Indian, I would say, public market domain, where I could possibly invest in petrol right now, and I could invest in fuel right now and gas right now and possibly get a better return in India as compared to any other geographical jurisdiction as such. So what I'm trying to say over here is, the shift did not. I mean, the shift is not a shift because of the pandemic. The shift is primarily because of the fact that the companies have quite matured over here, and the companies have reached full potential, I would say. And in US, I would the San Francisco area or the Bay Area. Um, uh, I'm not so optimistic in terms of the number of companies that produces which could be worthy of an SEC filing as compared to the companies that we produce in India, which is capable of a SEC filing. I'm sorry, I'm getting into a bit of a technicality, but that is worth noting.
Interesting. Very interesting points. I like that. Thank you so much, Dr. Shrikant. Kingsley, over to you, please. You're on mute.
I do agree with everyone's comment, and I also like Dr. Shrikant's patriotism in putting India forward. But as Peter said, and as it's all about security when you are investing. Regulations. So the regulations in India right now are probably not as transparent as that of America. If they want that region to grow, they have to be, it's a legal man, they have to create regulations and procedures that are transparent enough for investors to put their money in there. Because if it goes wrong, how do you get your money back? How do you get your investment? What is the legal process of going through all these things? But with SEC, with America, it is already in the open. We already know how it's going to work out. We already have the regulations understood by us and by our investors. But unfortunately, I am not aware of the regulatory concerning India, and that makes it more difficult for us. It's like me trying to say, okay, I want to bring companies from Nigeria to go into SPAC. Yes, there are companies there, but I do not understand the regulation and volatility of the system right now. So when it comes to investing in SPAC, yes, people are more comfortable with going to safe haven, let me call it that way, which is like America, Britain, wherever it's developed right now. But yes, there's more opportunity of making triple of what we are making in places like India, but people are more interested in secured investment. Secured investment. How this investment is secured. The company we're acquiring, who are those behind it? Or who are those going to be pushing it forward? Yes, right now the pandemic has given different opportunities to different regions. I mean, like when you look at technology right now, it's growing everywhere. AI is everywhere. When you look at data management, it's growing everywhere. But at the same time, we have to be able to filter which sector we want to invest. And once you have those sectors selected, then you have the companies you want to acquire. Does those companies have the right management to make it happen for you? Are they bringing in value? Now, the security they have is why most IPOs fail is cash flow. They don't have liquidity. But because it's been acquired, the company acquiring it already have the liquidity ready to be spent, because they also have to use that money between 18 to 24 months. So these are regulations that are very open to us. We are able to read about if it's America or other developed countries. We also want those information from developing countries, so we are also able to invest in those areas. It's not as if we are segregating, but you want to be able to put your money where you can get it back, or where at least if somebody goes wrong, you can say, hey, what happened here? So I think that's the area we have to look at. Security, we have to look at accountability, we have to look at what kind of returns are you looking at. Yes, that is very important. But what is most important is security of your investment. And that comes into play. Then who are those managing your fund? Who are those going to be in charge of this company? What are they going to do that will add more value to the company? Not just, okay, now you are listed, so what? You are in the public, right? Since you are in the public, all those things we've been able to hide it now will now come out. People will not say, hey, you're not doing this right, you're not doing that right. Now, will they be able to rectify it? Do they have the ability to be able to adjust to fit the new vehicle that they are in? Because they're leaving one vehicle, it's like you're leaving a Toyota and you're going to a Ferrari. So are you able to handle the speed of that Ferrari? Are you able to handle the movement? So it's as simple as that. So when we're looking to invest in any project, be it SPAC, be it any other project, we put all these things into consideration. And I believe that is the best way to go. Yes, SPAC has a lot of, I mean, it's going to grow for a few years. And like Peter said, it's going to, those who are not in the right wagon are going to fall off. Those who are in the right wagon, they have what it takes to be in that division are going to go up. And that is my belief.
Yeah, I think I sort of understand here, like both Kingsley and Peter said, it's the management team that is very important here in any SPAC deal. So just maybe maybe it's just my, I don't understand. So it's just management team, if I understand, should be in a safe haven jurisdiction like US and a developed economy as opposed to emerging markets. Is that correct? Or
very important? Yes, very important. If emerging markets are good, but they have to come up with regulations and legal foundations that will make us understand, okay, it is now safe for us to put money here. So once that is done, we don't have a problem.
Interesting. Thank you so much for those insights. I have got one question as well. Sorry, I'm going to go with Peter first. So what are the pros and cons of SPAC route? We also want to talk about the traditional IPO because they both help startups, private companies to go public. What are the pros and cons of SPAC route versus a traditional US IPO? Is SPAC a short-term structural finance fad, or is it here to stay and change the IPOs for the long term?
So number one, listen, the SPAC is here to stay for the long term, as it has been here for the long term. It's obviously a very broad and deep market in the U.S. for SPACs, pipes, and other ways to tap the public markets. In terms of your question, in terms of an efficiency point of view, it is a quicker way for a company that's looking to be acquired to tap the capital markets. Why? Because a shell company has been created, okay, that's publicly listed. So the acquired company can simply merge into that shell company and then be publicly traded without having to go through a very long process of regulatory and financial reporting, because that was already done by the initial SPAC prior to its listing. However, a SPAC still has to go through a regulatory systematic process with the SEC for it to be listed as a blank check special acquisition company, requiring proper underwriting, legal, etc. So that can't be done in just 30 days. It takes several months to do. Right. Once that's there, though, it's a publicly listed company, can go out and acquire another company. So that smaller company that's private might not have to go through all the regulatory SEC and legal hurdles if it was to do it itself. There's already an existing shell company, hopefully, as I mentioned, with an experienced management team for the acquisition. So I look at it as a more efficient means and possibly a more accelerated means for a company without the necessary knowledge to become a publicly traded company. But in the end, it's simply a structural means of tapping capital markets. It doesn't change the fundamental operational needs, management needs that are required to create value for that company.
Right. Thank you so much, Peter, for sharing those views. Next, I have Karthik. Same question. Is it a short-term? I mean, I know the sort of answer.
I would go with what Peter said. It's fast, efficient, risk minimized, a combination of dollar plus management and bringing in synergies at multiple levels, which is what a private company that wants to go public would necessarily be looking at, without disturbing the management control, without getting into the hassle of regulatory jurisdictional and regulatory bottlenecks. I think it's a faster and efficient access to capital. In terms of valuations, at the end of the day, it's going to be a company's fundamentals that will drive valuations. After a SPAC merger, there's always going to be a little bit of a dip, which can work against it. Also, the euphoria of market dynamics and valuations might not give it the kind of fillip that it requires, which can be a con for it. But there are more pros than cons in this case, primarily considering that access to dollar becomes easier and the company gains a lot more than just a dollar. It gains a very strong management and regulatory support and jurisdictional support. So I would look at it that way.
So, so on that note,
Going
am I
public,
right?
companies, a lot of companies aspire to go public, but the fact that they neither have the bandwidth, nor they have the wherewithal, nor they have the support systems that enable them to go public necessarily reduces or hinders that growth. SPAC would give it that wings that it requires and allow it to focus on driving the core of its business, while dollar acquisition is managed by somebody else, and it at the end of the day merges at the right time, which is the way I would look at it.
So what about Middle East, South Africa, the region that you tap into? No, nothing.
Nothing. It's. I wouldn't say it's too evolved. I would say the reason, and there's so much cash sitting on the fence at the moment in Middle East, considering that COVID has stopped a lot of businesses and investments have, I wouldn't say come to a standstill, but are now picking up momentum. There is a reason for people to go direct. Anything which goes through a consortium route or anything which goes through a channelized route for people in terms of investment is a challenge. And in terms of for companies going IPO, the exchanges in the Middle East or the aspirations for a Middle Eastern company to go IPO is significantly lower than what we see in subcontinent or in the US.
Got it. Thank you, Karthik. Next, I come to you, Dr. Srikanth.
No, I see the future to be quite optimistic. I mean, I'm sorry, I may be repeating the same points that I had made earlier. From a return perspective, I think we are quite set in India. At least the Indian family offices, the traditional Indian family offices, are quite set. When they look at acquisitions outside India, from an acquisition standpoint, this is just one of the considerations that they have in mind. I do not think there's a significant consideration that they have in mind insofar as making an acquisition. I mean, they don't go out and hunt for a SPAC deal. Is what my experience has been. I mean, of course, the panelists may have different experiences, but I have never come across a promoter or for possibly $1 billion coming to me and saying that, look, I'm looking specifically for a SPAC deal or for this particular company to be listed in a NYSE or in possibly in Singapore Stock Exchange and so on and so forth. So to me, it's more of a structural format rather than an investment format.
Okay, all right. Thank you so much. I think towards the end of the show, I just want to know, since the topic is the target sectors. So, what sectors have we seen in 2020-21 are the key sectors that are good targets for a SPAC investment? I would like to start with Peter. Peter.
I'm sorry, my mic was muted. As I mentioned at the start, it's not necessarily what companies are good for SPAC investments, because it's all industries, various asset classes. It basically comes down, and that could be AI, that could be crypto, security, that could be a hard asset that company, whether it's real estate, hospitality, hotel, telecommunications, healthcare, every industry under the sun. Okay, NASDAQ, S&P 500 is a possibility. What it comes down to is fundamentals. And that fundamentals is basically can the company be operated more efficiently with a better management team than the current management team as a publicly traded company versus a privately operated company? That's question one to be asked. If the answer to that is no, then it's not an appropriate vehicle for either an IPO or a SPAC or any other means of bringing a company to market. The second question that happens is, does the management team of the SPAC add value or complement the management team that exists of the acquired company? If it can't add more value or complement that existing management team, valuation would be destroyed. Okay, so those are my two comments there, and I think they're very, very important questions for anybody to answer. Now, if you have a company that's looking for venture capital money and say, oh, I've got a company and I need to raise A rounds or something like that, let's do a SPAC. That's the easiest way to market. Okay, the market is smart enough to understand whether that company can be acquired and would make sense in a SPAC format, IPO format, or would simply be best funded in the private space through a venture capital fund.
Very interesting, very interesting. And the crypto thing was very much interesting as well. Thank you, Peter. Karthik, over to you.
So I would say it's not about the sectors; it's about the companies that have reached a particular level of maturity, have been right sized, have shown certain amount of growth, and with their investments in a lot of businesses and sectors in last 3-4 years, every passing year we would see a lot more companies getting into that stage of maturity where they would have IPO aspirations. And depending on the size, scale, and type of business that they are in, there would be some or the other people who would be willing to pick them up through a SPAC route. So it's pretty sector agnostic. It's the maturity stage of business that would define. And anybody who's got that right level of business, which is scalable, profitable, and is generating value, there would be enough takers for them.
Right. Very, very interesting. Absolutely. I think I'm getting, it's just hitting me now, right now. Thank you so much, Karthik and Peter. Dr. Srikanth.
Yeah, I now I agree with. I think we have a consensus with the panelists. Sector agnostic, right? I mean, you really can't put a finger in a particular sector and say that, look, this particular sector is back. So that's the reason why I caveated my statement by saying that I don't think we should be talking about which companies are great acquisitions. I think we should talk about which emerging economies are great areas to be talked about when it comes to SPAC acquisition. From that particular point of view, I think again going back to India, Indonesia, we're talking about Vietnam. We're talking about. I'm sorry, Sunny. I may have to take a differing position against where you are domiciled right now, which is Singapore. I'm not too optimistic Singapore as such, but I would say the emerging economies are the next thing. For example, in Israel, talk fintech company which is based in Israel. You want to take the company IPO, you don't have a mechanism to list it in the Israeli market as such. So what do? You take it as a SPAC and you take it to the US, right? So that would be the right mechanism to do it. So I think it would be more of a geographical separation that we have to do than the sector separation that we need.
So if I understand correctly, Dr. Srikanth, I think the startups or the company that management, the shell companies will acquire are more aspiring to go US IPO as compared to startups in Singapore?
That is just an example. That is just an example that I gave. The Israeli companies are very well welcome. I mean, being in the government, not take position against the government over here. So are very well to India. Please invest in India. But what I'm trying to say over here is there are so many jurisdictions like Israel where you do not have a easy capital market system where you can possibly go public. And I think an analysis of those kind of jurisdictions or those kind of geography would be of. For example, we have Nathan who used to talk about the investments in Ethiopia, in South Africa, and in other I would say South African countries, right? There are so many startups that are coming up over there, and they do not have an opportunity to go public all over there. So what do? They can't go public in Dubai. They can't go public in say the London Stock Exchange. So they have to resort to some other means. So I think from that particular point, I think there are so many jurisdictions that you can, or so many. I tend to say jurisdiction because of the legal angle. I'm so sorry. There are so many geographies that you can touch upon, or so many countries that you can touch upon, which are still like developing and moving on to the developed nations. Such.
Hmm. Very interesting, Dr. Shrikant. Kingsley, what's your take on, is it sector agnostic, and do you think all these startups from emerging markets, as Dr. Shrikant said, Africa and Latin America, have an opportunity to go public via this special purpose acquisition company?
Everyone has an opportunity. The system is built for every region, for every project, for every company to grow. I don't think region will come into a play, because when you look at Africa, last year Africa came up with more than 400, 1 billion and over profit companies. So we have growing economies around the world. We have growing people around the world. But at the same time, there's a trend. Well, when it comes to human beings, we follow trend. Recently, we've had this space trend of Virgin Atlantic and Bezos all going to space. So that will definitely shift people's attention to investing in space projects. So we also have, for example, blockchain that was not there 10 years ago, now becoming very, very popular. So that's a trend. So human beings tend to follow a trend. So what trend are we looking at right now? We're looking at technology. We are looking at AI. We are looking at environmental impact companies. We are looking at energy, renewable energy, and things like that. So these people have more advantages than others who are just doing, let's say, I don't want to mention other names, but they have more advantages in the market than other projects. So if you are in the space sector, you are in the technology sector, you are in the AI sector, you are in the energy sector, you are bound to find people who acquire you faster than other companies. I mean, we all know there's a scale of preference, prioritizing. If I have to invest 200 million in a business right now, I will invest it in a trend. What is the trend? Space exploration. What is the trend? AI and robotics. What is the trend? Technology. What is the trend? Environment. So I think there's going to be a sector that is more likely to have more advantages than others. And we should look into this while investing, while acquiring company. I would definitely go with a trend that is backed up with assets right now, backed up with whatever is going on around the world. And I believe that these sectors I mentioned will do better than other sectors in the nearest future.
Thank you. I think trend is now crypto.
Yes.
Thank you so much. Thank you so much, Kingsley, Dr. Shrikant, Peter, and Karthik. I don't know what about you, but I learned a lot. Like, these are the sessions where I learn more than probably hours of reading. So thank you so much, Peter, Karthik, Kingsley, and Dr. Shrikant. Let's take some quick closing thoughts before we wrap up the show. Peter, over to you.
Sony, thanks again. It's always an honor and a privilege to speak with some of your distinguished guests. Listen, the SPAC format for a company to tap public markets has been on a roar over the course of the last year. I think that trend will continue. I think the market will differentiate more between the winners and losers, the winners being determined by those management teams that have the historical and forward-looking basis to execute on their plan and obviously improve that company's fundamentals, which will be a lead to a more attractive valuation, and then obviously attract more retail investor as well as institutional investor interest. I can be reached at peter.cloud@weimerfinancial.com. My phone number you can get from Sony. Reach out. Happy to discuss anything about SPACs or any other investments and how a family office like ourselves look at various investments across asset classes. So thanks again.
Thank you. Thank you very much, Peter. Karthik?
Thank you so much for having me on the show once again. And it's always been a pleasure to meet distinguished panelists on a beautiful discussion like this. I believe that there is a lot that SPAC would do in the next few years, with more and more businesses reaching Seed C and Series C and Series D funding and getting ready for the IPO. I think there's always going to be enough appetite. Valuations would start stabilizing, new indexes to evaluate the management, which is the non-product or non-mathematical roots to businesses, would start featuring, and hence a new index of sorts would form in due course of time. Happy to stay invested, happy to stay interested in this space. If the discussion with Gary materializes, then yeah, that would be something interesting for us. In terms of reaching out to me, happy to be reached through LinkedIn and through VCTV. Absolute pleasure once again. Thank you.
Thank you so much, Karthik. Next, I have Dr. Shrikant.
Yes, as far as legal opinion is concerned, so I've dealt with certain matters in this particular case. So feel free to air out your issues as such. I'm reachable at Dr. Shrikant Parthasarathy, the only Dr. Shrikant Parthasarathy who's got a legal counsel and such other degrees along with his name. Okay. So feel free to reach out to me on LinkedIn.
Okay, it's only Dr. Shrikant Parthasarathy. Thank you so much. Next, I have Kingsley.
Hi, Sonny. Thank you very much. It's been a pleasure talking to everyone tonight. I mean, it's a wonderful evening. A lot of insights, a lot of contributions. A lot have been learned from everyone here. I'm happy to be back at that token, and this was a very good subject to start with this month. My name is Kingsley Kobayashi. You can reach me on LinkedIn, my official Facebook or Instagram, or just go through La Token and Son know how to get to our company and to me. I know that, so there's no problem at all. Pleasure seeing you again, Sonny. Thank you, guys.
Thank you, Kingsley. So I know everybody's number. I know everybody's contact email and contact address. So guys, always reach out to me if you want to reach out to Karthik, Kingsley, Dr. Shrikant, or Peter for that matter. I really enjoyed the show. I'll be back again on another episode with new set of speakers and a new topic. Till then, take care of yourself. We're going to see you again. Bye.
Take
Stay
care.
safe.